Today we're talking to Brady, the CEO of Bonzo Finance. Our first video that we did with Brady, we discussed Bonzo Finance from soup to nuts, how it works. Today we're focusing and digging in on exactly how interest is calculated. I think it's worthwhile to understand, not just for the Bonzo Finance protocol, but for all decentralized finance protocols. Let's get started. Disclaimer. The views in this interview are personal and not official Bonzo Finance advice. Any forward-looking statements about Bonzo Finance and its associated projects involve risks and uncertainties. Please do your own research and consult a professional before making any investment decisions. Bonzo Finance and the speakers on this interview today are not liable for any actions taken based on the information provided. So today we're talking with Brady. Again, we did a video before regarding Bonzo. He's the CEO of Bonzo Finance. Welcome, Brady.
Yeah, thanks for having me. Excited to do round two with you, diving into some of the specifics of the protocol.
Of course, I think the last one was actually really helpful to me, and I think to a lot of people to understand how it works. So this will be another good one talking about the interest rate model and utilization. Just if someone is watching this for the first time learning about Bonzo, can you kind of just give a 10,000 foot view and explain what you call the liquidity layer of Hedera?
Yeah, definitely. So some background on myself. My name is Brady Gentile. I'm the co-founder and CEO at Bonzo Finance Labs. We contribute to the development of the open source Bonzo Finance protocol. And Bonzo Finance as a protocol is dubbed the liquidity layer of Hedera. And what we mean by that is Bonzo Finance has started initially as a decentralized lending protocol. And many folks have supplied assets into that protocol. I think it's sitting at about $46 million in TVL today on the Hedera network, and then borrowing from the assets that are being supplied or lent. And the culmination of liquidity that exists in the lending protocol acts as a layer of liquidity where oftentimes in many ecosystems for DeFi, there are protocols that can be built on top of the lending protocol that allow for things like perpetuals and futures, for example. Also being able to use the Bonzo Finance interface as an entry point to many things across DeFi within the ecosystem. So today it's lending and borrowing, but there are some products that we'll talk about at the end, like vaults, that come into play, which actually route liquidity across the ecosystem. So single interface, and looking for Bonzo Finance to be that layer of liquidity and entry point into DeFi on Hedera.
I've been following you all since last year, 2024. And correct me if I'm wrong, if I have the dates right. It went live October 2025, and then the token was available October 2024, and then the token was available in February of 25.
Yeah, went live October 2024, and then borrowing was enabled in December of 2024. And then, yes, governance token was available in February.
In my mind, I wanted to point that out because I think you all have accomplished a lot in a very short period of time. So I think that's impressive.
Appreciate that.
Let's take a look, and I'll show here alongside our discussions on the initial page when you launch Bonzo. Got the supply section, the borrow section, and then the assets down below. If we look at, for example, USDC, we've got 5 data points here: total supplied, total borrowed, utilization, and then supply and borrow APY. Can you talk a little bit about that, in particular utilization, and then we'll dive down into it in a second?
Yeah, definitely. So right. So on that dashboard, there's a list of supported assets with some global metrics for each asset's market. The total supplied is the amount of liquidity across every user that has supplied that asset to the pool. And then the total borrowed is across every user that is currently borrowing that asset. Then there is, as you said, the utilization rate. Utilization rate is basically just a division of the amount that's being borrowed divided by the amount that is supplied right now. So in total, that market, based on its utilization rate, that's the percentage of the amount of liquidity in that market that is being borrowed against what's supplied.
That makes total sense. When people think about their own credit cards or credit card reporting, when you go in and look at your FICO score, it always talks about the utilization rate of your credit card. If you got a $10,000 credit card, you've used 2,000, you're at a 2,000 utilization, you've borrowed 2,000. So this is showing the exact same thing. And then, of course, we've got the supply and the borrow APYs, which can change. And everyone's always asking about that. So I'm going to dig into USDC and we can talk about the interest rate model itself. And before we start, at the very top, it's got the Oracle price. Can you explain that?
Yeah, so the Oracle price is the price currently that the Oracle has most recently fed to the protocol. So that's going to be reflecting the rate or the price at which the protocol perceives the US dollar value of that asset that is both being borrowed and supplied. And the reason why that's important is the Oracle needs to understand the protocol needs to understand the actual value of any of these tokens that are being supplied or borrowed in order to ensure that there is an appropriate loan to value ratio to ensure when a liquidation might need to take place. You can only borrow a certain percentage of value against collateral that is supplied. And so that's where that price comes into play. And then the Oracle itself, there's two oracles that are used in Bonzo. One is the super oracles and the other is Chainlink oracles. And it's different per asset. And the way that these oracles work is they take sources of price from multiple locations and try to keep it decentralized and also reduce risk of, maybe one price source or one, trading venue has an issue with the price, or someone has, bought or sold a significant amount of an asset on one trading venue. The Oracle is determining a true price based on multiple sources. And there's a few different calculations that it uses for that. But that's part of it trying to prevent sort of manipulation from taking place.
To dumb it down, in essence, if we're thinking about stocks, you've got a stock, it's typically listed on just one exchange, let's say the New York Exchange, and you can find the price right there. Crypto, of course, there are many exchanges. And like you said, they can vary slightly one between the other. Therefore, they try to take some sort of an average to make sure we've got whatever the current price may be of that crypto asset. And you're using a third party to do this, like a Chainlink, which is very well known. Okay, so as we go down, we've talked about, it shows here total supplied, total available, and you mentioned the utilization rate is how much is being borrowed against what's being supplied. And we've got these APY rates. Can you dig in here to the interest rate model and these two slopes and what this means?
Yeah, definitely. So in looking at the interest rate model, so there are three parameters that can be configured for the interest rate model of every asset. Each asset is going to have its own interest rate model. The framework that's used is exactly the same, but the configuration is going to be different. And so that framework for USDC, that framework for the interest rate model is what's called slope 1, which is that blue line that we see, slope 2, which is the orange line, and then an optimal utilization rate. And for this framework, the way that it is set up is slope 1 is always a more linear progression along the curve. And then slope 2 starts at the optimal utilization rate and increases much more exponentially than slope 1.
Yes, slope 1 is clearly, it increases much slower. For on USDC, it goes up here to about 13%, and then slope two just rockets up. Why is that?
Yeah, so for the interest rate models themselves, there's two lenses in which you can look through with regards to their configuration. The first lens is from a risk perspective, and then the second lens is from more of an economic perspective. So
Okay.
from the risk perspective, the behavior that slope one and slope two sort of dictate or drive is um, all of the utilization of the pool. So the amount that's being borrowed relative to the amount that is supplied as a percentage. Um, slope one goes all the way up to the optimal utilization rate. So as more and more people borrow, it is increasing the rates, the supply and borrow rates, in a linear way, more slowly, all the way up to the optimal. And the behavior that that's incentivizing is it is trying to drive users to be able to supply and borrow funds up to the optimal utilization rate in a more stable way. So, between 9% like 50% utilization all the way up to like 80% utilization, the change in the supply and borrow APYs um, isn't too drastic relative to maybe the same delta uh, if it was past optimal utilization and into slope two. So more flexibility, more predictability, and more of an ability for people to be able to supply and borrow funds within the slope one range more easily.
If we use an example, since I'm glad we chose USDC, it's a stable coin pegged to the dollar. So we're just going to assume we've always got a price of a dollar.
Hmm.
If we started with a group of people have put in $10 million worth of USDC, it says optimal utilization for this happens to be 85%
Mm-hmm.
for this asset, USDC. So in other words, 8.5 million being borrowed out of the 10 million would be optimal. And when it says optimal, what is that exactly implying? That's implying that if I'm putting money in, I'm getting probably the best rate with the least amount of risk, meaning there's still money available if I wanted to withdraw. I guess that would be my only risk as a supplier. And as a borrower, I would have the most optimal, I guess, rate. It wouldn't be too high. It would be adequate.
Yeah, and optimal
Did
utilization
I get that
is
right?
it is right. That's accurate. And optimal utilization is it's basically where it is there is believed to be the greatest sort of balance between supply and demand for this specific asset market, and deriving sort of where the optimal utilization rate should be is based on analysis done across the existing ecosystem, the asset itself, the broader sort of macro DeFi, and even TradFi markets. So there's a number of factors that go into an analysis to determine, where is the greatest amount of sort of balance between the supply and demand curve for
Okay.
these interest rates.
So let's talk about it hits the optimal utilization rate, in this case, 85%.
Mhm.
And then that's when slope two kicks in. So when it goes to 90%, 80 or 85% and above, why is it exactly that you want to increase the rate so fast?
Yeah, so good question. So using the example you provided where let's say a number of people supplied $10 million of USDC into this market, and over time, more and more people are supplying collateral and borrowing USDC against it. And as more and more USDC is borrowed from the $10 million, slope one is enacted and it continues, the utilization rate continues to increase. So, optimal utilization in this example then would be $8,500,000 is the amount that is borrowed that would hit that optimal utilization rate. And the reason that slope two increases so exponentially past that point is a behavioral mechanism. So let's say people continue to borrow past this optimal utilization, and it goes to like 90% or 95%. The interest rates increase faster as it continues to increase along slope two. So the borrow APY becomes higher more quickly as people are continuing to borrow past optimal utilization, but so does the supply APY as well. And the behavior that this is driving is, many folks who maybe have an active loan of USDC, they don't want to pay this higher interest rate. And so they're incentivized to pay back their loan to drive the utilization back down. Or, and oftentimes it's in combination, or it is that it is very lucrative to want to supply USDC into the pool because you'll be earning a higher interest rate on any of the USDC that anybody supplies into the pool is higher. So that also decreases the utilization, because if you increase the amount that's available to borrow and you keep the borrowing amount the same, that percentage goes down.
Okay, that makes sense. So for each asset, you've been able to come up with, and I think I'll show this in your documentation because you've got it for every single asset, this utilization rate, the optimal one, which essentially is the most efficient this system will run, so to speak. And the rate increases quickly so that you can try to drive it back to the optimal utilization rate. So if my rate's going up on my borrow, I might want to pay some back. And if I'm a lender and I see the rate take off, I might want to put more in. Both of those two levers, if you will quickly drive the market back to its optimal rate. So for Bonzo to be at the most efficient, each one of these assets wants to get to its optimal utilization.
Exactly. Yeah, exactly. And when you look at, so like under slope one and slope two, you have these percentages. If you were to take slope one, for example, it's sitting at 13%. If, let's say, 20% was applied to it, that is going to increase the curve of this slope. So it would end up being much higher at the optimal utilization point. And so interest rates would increase more quickly if it was 20% versus 13%. And that's the same with slope two as well. And so essentially slope one, that percentage, and slope two, the percentage acts as like it's more advanced of a calculation than what I'm about to say, but it's a reasonable way to think about it. Is it's almost like it's the max APY in a way that will be hit at its maximum for the slope.
So for this USDC, optimal utilization being 85%, that means that the protocol wants to have a 15% buffer of USDC. Why? Why not just take it to 100% or 99%?
Yeah, great question. So the reason why there needs to be a sort of a mechanism in place that drives borrows down or supply up is because let's say it is at 100% utilization. The entire pool that's been supplied is currently being borrowed. There's no room then left for any suppliers to be able to withdraw their funds from the protocol because those funds don't exist. Those funds are they do exist, but they're currently being borrowed. They're in the wallets of other users who have borrowed it. And so having that buffer is really important in just ensuring that lenders still have the flexibility of being able to withdraw funds to a certain
Mhm.
degree. And then, if users aren't able to withdraw all of their funds because of the current utilization, they are at the very least earning a very highly incentivized rate for the fact that their funds are not able to be withdrawn.
I didn't think of it that way. Okay. I mean, I understood that, yeah, you want to have a buffer so people can withdraw. But if there's a mass run, obviously we're still going to be earning, those of us that put money in, a substantial rate. So there will be no complaints. Um, Now, why would certain assets have a higher? I'm assuming USDC has the highest optimal utilization rate. Why are others lower?
Yeah, so a big, like a heavily weighted part of the calculation is around the volatility of the asset. Um, and it's the volatility of the asset relative to the volatility of the other assets within the larger market that is available for supplying and borrowing. So, you can supply HBAR or Karate or, any of these other assets and then like borrow USDC in this example. And for assets that have a, um, much more volatile like history, um, they have a higher likelihood of the utilization rate also being volatile. And so having a larger buffer helps to ensure that, sorry, not a larger buffer, but a lower optimal utilization helps to
Mhm.
ensure that even with the volatility, it is within a range that is, plus or minus a certain amount that is still to be considered like within the optimal supply demand for that market.
Out of curiosity, is that something that's done dynamically through something like an Oracle determining volatility across exchanges, or like a quarterly review? How do you do that?
Yeah, so for Bonzo Finance and most decentralized lending protocols, they have an independent risk steward or multiple independent risk stewards, which are running analysis on the markets that exist within the lending protocol and those assets that are supported within those markets. And through that analysis, they create proposals that are changes to these interest rate models, but also to the other risk parameters, some of the ones that we talked about in the first video, such as supply
Okay.
caps and borrow caps and loan to value ratios, liquidation thresholds. And so through that analysis, usually it depends on the number of assets supported by the lending protocol, but there's at least a few changes that happen within every quarter
Okay.
that are applied or recommended to be applied. Um, and then through those proposals and DAO voting, the DAO or token holders vote to pass the proposal, and then the adjustments are made. And
Oh, okay.
yeah,
Has that hasn't happened yet? The Dow voting, or has
not
it?
yet. By end of this year or early next year is when the DAO for Bonzo Finance will go live. Today,
Okay.
we're in sort of an intermediary step where the proposal process is exactly the same as if when the DAO is live in terms of the format of the proposals and the publishing of them. They're published as change memos in the documentation and
Mhm.
reviewed by the team and the Bonzo Finance Foundation and various parties right now for implementation. But when the DAO does go live, it'll switch from this change memo process to instead being a true DAO proposal, and all of the community members that are token holders end up voting on the passing of these.
I think that's great. I'm going to jump over and we'll show this documentation that you all have put together, which is extensive. And in particular, we'll point out to this liquidity risk section. It goes through everything that we've basically discussed. What I think is fascinating is that, if you think of, this is why I love decentralized finance. There's many reasons I do. Being older, I have, and having many businesses myself, I despise banks, small banks, not investment banks, but small banks. And so imagine if you went into a bank and said, let me see all of your documentation and how you all operate in your business model. Not in a million years, but we can read about everything you just discussed and everything that you do. And then soon, those of us that participate through holding Bonzo tokens will also be able to essentially manage the bank. It's not a bank. I know it's a liquidity layer, but as more and more things are introduced, I think that's fascinating. So for people that are involved, they'll be able to vote on those. So interesting to not only know how everything works and being able to read it, but to also participate in some of the future changes. And that's always going to be, what was the name of that firm, or you have multiple ones that do these? They're third parties.
Yeah, they're independent third parties. The one that is working is contributing to the Bonzo Finance ecosystem is RE7 Labs. They're
Okay.
a very reputable provider within DeFi. They do liquidity management, but also run a significant amount of risk analysis. And so they're structuring like a full analysis on the Bonzo Finance protocol, markets, assets, and also introduction of new assets too. So like if there's a new asset that comes online, which is happening right now with like wrapped ETH from layer 0, that's one that is very keen on being able to have that be supplied and borrowed within Bonzo Finance. And so they do an analysis on existing assets and potentially new assets as part of that.
And are they on the regular quarterly system, or do you have them on a different 3-month? So when might we see some of those new recommendations?
Yeah, so for this like wrapped ETH listing, I would estimate that maybe within the next 3 to 4 weeks.
Oh, great.
Yeah, so pretty soon. And then those changes are ongoing. So it's not necessarily like a strict set number of changes per quarter or per month or week. It's more of it's an ongoing assessment of the changes in the market, and based on those changes, deciding, hey, actually there needs to be some updates to these various parameters for these assets within Bonzo. And they'll quickly put together a change memo and submit that, or a DAO proposal and submit that. So it is a very
Okay.
liquid, ongoing structure.
I hope when people watch this, they pick up on certain things that you've said. Like, for instance, I think it's very important when you mention it's an independent third party doing these risk analysis, just like the pricing that comes in is coming through one of these oracles. A lot of this is very methodical, and it might be counterintuitive to the way people are used to seeing businesses run. That's kind of the beauty of decentralization, is that it's not someone sitting behind a desk, checking yes or no to some of these things. This is very methodical. You've got third parties, and you're doing this risk analysis. Was there anything about the interest rate or the utilization that I didn't ask that I should have?
Well, so I think first, to your point about like the decentralization and independent third parties and everything, so right. It is interesting talking to like my parents or family or friends who maybe don't have a lot of experience in the Web3 space, and sort of how these autonomous organizations and protocols function. And it's such a different way of thinking, and it is very interesting. And one of the things that I've always felt with regards to whether it's a network or a protocol that exists on top of a network is the team's goal I think should be that you are a launch pad and you get these things out and then into a fully autonomous state whereby they can continue to operate. And if you, for whatever reason, let's say the team passed away or something, like catastrophic situation there, but it should be able to continue to persist. And that's also the fact that it's open source as well. So the goal of, I think, teams launching networks, protocols, et cetera, it should be that you're trying to get it to a place where it can continue to exist without anybody having to be like a sole organization or contributor. And that's kind of the true sort of decentralization vision um, that a lot of folks talk about in the industry. And I think with regards to the interest rates and the parameters here, one other thing that is worth mentioning, I think, is around the caps. So for caps, they do have an impact on utilization and these rates that we've been citing. So there are supply caps and borrow caps, and both supply caps and borrow caps are based on a token amount rather than like a US dollar value amount or a specific percentage of utilization. So in using the example that you described of 10 million of USDC supplied, let's say that there is a supply cap of 10 million and a borrow cap of 9 million. In this example, if everything was maxed out, you would have a utilization rate that can only max out at about 90%.
Mm-hmm.
But let's say there's only 5 million supplied and 2.5 million that is being borrowed. Because the supply cap hasn't reached its maximum, nor has the borrow cap, you could get to a 100% utilization rate where, if the same amount of liquidity is being borrowed as it is supplied because it's below the maximum thresholds there. When the amount is at the cap, it does limit certain functionalities. So like we talked about how slope 2 drives the behavior of either more people supplying or folks repaying their loans in order to get that utilization rate back down. If it is at its max cap, it eliminates the ability for folks to be able to supply more to push that utilization rate down. So it does require folks to have to repay their loans to push it down, and that's fine. That's how these caps work. But it's worth observing that, and that's only the case here when it's at its absolute maximum for both sides of supply and borrow.
Okay. Any reason why some have caps and some do not?
Yeah, so the biggest reason for caps is based on the amount of secondary liquidity that exists in the ecosystem as a whole.
Okay.
So, you can imagine if I could supply an unlimited amount of a certain asset as collateral and borrow against it, I'm creating risk for counterparties. So people who have supplied the asset that I'm trying to borrow, and risk for the protocol, and risk for the token that I am supplying as collateral. For the fact that if I do get liquidated, and let's say it is a significant amount of collateral because it was uncapped, the liquidation bot that seizes that collateral in order to repay the loan and ensure that lenders are made whole, they would then go and sell the collateral on market. And if there isn't enough liquidity for that asset to be sold, it can cause some pretty big damage with regards to sort of the ecosystem as a whole. So I guess it's like a step by step. It would be a large liquidation takes place. The liquidation bot that sees that collateral, they sell that asset on market. It drives the price lower. More liquidations take place because the price ends up being lower. The liquidation bot liquidates those. It becomes this loop in a way. And so when you think
Right.
about caps on, well, global caps on, what you can supply as collateral to the protocol, that's a big factor that is brought in as part of the assessment. Is what can the ecosystem and that asset in particular actually handle in terms of safety?
I'm glad you said that. Let me see if I can again dumb it down. What you said made perfect sense. But essentially, in a case of an asset, let's say a particular crypto does on these exchanges 1 million worth of volume in a day. So 1 million tokens are traded within a day. And you're saying if I happen to have supplied a lot of that and I got liquidated for whatever reason, then, and let's say 2 million, I had 2 million liquidated, all of a sudden a lot more is being sold than a typical day, which will greatly drive the price down, which creates this death spiral. Because if the price goes from $1 to 50 cents, other people may get liquidated if they had borrowed against this asset and its value dropped. And that's when you've got this cascading effect. So I'm glad you said that. This is yet another way in which you're using this independent third party to do an analysis and say, all right, to keep this, risk free, not risk free,
Nothing's risk free.
as healthy as possible. Yeah. What you put caps on certain of these assets by so that what else are that's interesting. What else are they doing? I mean, they're looking at the utilization rates. They're trying to make it optimal per asset. They're helping with the caps. What else do they do? I know this isn't what we initially were talking about, but it's interesting.
No, it's a good question. Yeah, so it is really, it's all of the risk parameters across the protocol. And, referencing back to the first like educational video we did, we talk about a number of those risk parameters. So like loan to value ratios, liquidation thresholds,
Right.
liquidation bonus or liquidation penalty, which is the essentially the discount that liquidation bots receive when
Mhm.
seizing collateral, the supply and borrow caps, and then these interest rate models as well. And so, yeah, all of that falls under the umbrella of like a third party independent risk steward to, make informed analysis on the change memos and the proposals that they make. They go in depth into sort of explaining how that analysis sort of is a derivative to the changes that they want to make and the justification for that too. So, optimally, these change memos or proposals are very in depth in their explanation of why. Just ensuring that the community can make the most informed decisions on voting when it comes to that.
No, I'm glad you have that. Well, this has been interesting. I know myself when I first got involved with it, I thought it was interesting watching the supply and APY. I mean, supply APY, borrow APY change and fluctuate, and I was always wondering why. How did one change and one not change? So thank you for explaining that. I think it makes perfect sense, and hopefully this will help people understand how this protocol and others work. Let's talk about some of the upcoming things. You mentioned vaults, some more things that you've got coming on.
Yeah, no, thank you for that. And yeah, we're excited about vaults. That's been, last few months we've been talking about vaults, and I'm sure some people are sick of hearing me say vaults. But
I'm not. I think it's interesting.
I appreciate it. Yeah, so those are looking to go live by middle of October. And what vaults are is a automated liquidity strategy, and there are many different kinds of automated liquidity strategies that users can supply liquidity into. So each vault is its own strategy, and
Okay.
what the vault does is it not only routes the liquidity that is supplied to it to other protocols across the ecosystem in DeFi, but it also automates the management of that liquidity And it does that to ensure that the user is able to get the most optimal amount of yield, and the least amount of management, like manual maintenance, that they would have to do for a specific strategy. And these strategies can be pretty basic, or they can get very complex and sometimes involve multiple protocols as some of the actions that the vault automatically takes action on for the liquidity that's supplied into it. So, one of the I guess more basic ones would be like a leveraged liquid staking yield strategy. So, you supply a liquid staking token to the vault, and the vault then supplies that to Bonzo Lend as collateral. It borrows the underlying base asset, stakes the underlying base asset, and then resupplies that to the protocol. And what you've effectively done is you're earning yield for the liquid staking token on leverage. And that's where that APY would come from in that scenario. And then, another strategy would be around supplying and managing liquidity in a Saucer Swap V2 pool. So if you've been to Saucer Swap's V2 pool page and you see all of the different configurations that are there for supplying liquidity into a pool, it can get pretty complex. You have to set these various ranges for for each token in the token pair. And depending on sort of how tight you set that range, which maximizes your liquidity, you may have to go in and maintain that far more often. And so what the vault does is allows you to supply liquidity to the vault, routes it to the Saucer Swap V2 pool, whichever one that vault is supporting, and then automatically manages those ranges for you, and tries to maximize the amount of yield that you're receiving, reduces the amount of maintenance that you have to manually do. And then it's also supportive of the ecosystem as a whole. So, a lot of times people are manually supplying assets to V2 pools in Saucer Swap, but they're not the best at maintaining them. And so the ranges are kind of all out of whack. When the ranges are like that, if someone comes along and wants to trade against that pool, but the ranges aren't maintained, you're going to have massive slippage and price impact. And so, these vaults aren't just doing a service for users supplying, it's also doing a larger service for, the ecosystem as a whole, and in this case, Saucer Swap.
Now the liquidity layer of Hedera phrasing for Bonzo makes more sense. The way you described it was Saucer Swap. But to give a very simplistic analogy for people who are used to, you go to a bank and you get a CD and you can get it from that particular bank. Some banks will have services where they'll say, you know what, we can get you a better rate, a different CD in a different place. You just go through us and we handle that for you. So in essence, these vault strategies are saying, hey, there's this unique strategy you might be able to implement to obtain a higher yield on your assets. You put it in the vault, we manage it for you. So from that perspective, I mean, that's great from the management side. The other thing I think is very interesting, which you alluded to, is these vaults could get very interesting. I mean, you have smart contract programmers and then you have finance individuals. And when you marry those two and they start implementing some interesting strategies, like you started to discuss, the liquid staking, the supplying, the borrowing, the looping of it, it could get very interesting. And it is, for many of us that have done these sort of things, like with Saucer Swap and others, yeah, it's time intensive and it's not a set it and forget it. These vaults could essentially be a set it and forget it, unless I've got it wrong.
No, you're right. Yeah, exactly. Yeah, and the other aspect of it too is that permissionless nature of the vault. So like you said, if someone has coding experience and experience in DeFi or finance, they can build a strategy and they can submit a proposal to have that strategy deployed, and that gets deployed as a vault, and then anybody can participate in that. And the benefit to the strategist, the person who built and deployed it, is they receive a small fee, a percentage of yield on whatever yield the vault makes for all of the contributors of liquidity into it. So it's a good like incentive structure, and it kind of ensures that people with those skill sets are incentivized to want to create interesting strategies. So yeah.
Sure. How much more do you want to talk about the vaults? You want to save that for when they come out? Because I have a million questions. Maybe we save that for another
That
video.
sounds good. Yeah. Yeah, we'll definitely have a ton to talk about once they go live for sure, and diving into some of the specifics of it.
I personally, I just see that as being huge. I mean, I can only imagine the ramifications. It sounds very interesting. Okay. Did we cover everything regarding interest, the utilization, and the interest rates?
I think so. Yeah, and we're always open to questions, comments, thoughts that folks have in Discord or on X. If you tag myself or the Bonzo Finance handle or jump into Discord, please ask questions. Like education, I think, is just the most important thing. The more people sort of understand the mechanics of these things, the safer you can make it, and then also just general understanding for everything has like compounding returns. People help educate other people, so we see that as really important.
Sure. I'll add all of those in the description of the video. I'll put them on the screen. And also to mention, you've got those Friday calls,
Yeah,
12 o'clock Eastern usually. And I think those are great because people can ask questions. I ask one or two, and they can also type if they don't want to come on and talk. They can also just add the questions and you all read them off and answer them. So I think those have been fantastic. I hope you'll continue to do those because it's very enlightening.
yeah, we definitely will. No, I appreciate that a lot, and thanks for joining those. They're very fun, and then like you said too, just the time at the end for people's questions. There's always a lot of like good questions that come through.
I think as a community, we really appreciate you and Garang as well, and everybody on the Bonzo team for the transparency and the communication, not just these videos, but like those Friday calls, and everything that you post on your X, and I know in your Discord as well. It's fantastic. So I'm glad you're doing it. Please continue to do it. It helps us learn a lot.
Awesome. Really, really appreciate that.
All right. Thanks. Glad to have you here today.
Thanks so much.
So thanks for watching. I hope you found it helpful. Visit bonzo.finance. You'll see the link here on the screen. There's also one down below in the description. And also please visit my crypto school. We teach all things crypto and Web3. Have a great day.